Traditionally, private markets funds were the domain of institutional investors. Not anymore. The newly revised ELTIF regulation is making private market investing more accessible to a wide spectrum of investors in the European Union. ELTIFs, or European Long-Term Investment Funds, can be offered as evergreen funds rather than as traditional closed-end or vintage year funds. That means investors get all the benefits of evergreen funds, along with the retail-friendly framework of ELTIFs. Those benefits include capital that is immediately invested in the funds, and no capital calls, semi-liquidity, and potentially low investment minimums. At Hamilton Lane, we were early in adopting evergreen fund structures, launching our first private equity-focused evergreen fund more than 5 years ago. As a continued effort to allow more investors to benefit from private markets in their whole portfolios, we're excited by the advancements ELTIF 2.0 brings to the European market. We believe it is historic in its aim to give everyday investors in the EU access to private markets. Why should investors care about accessing the private markets? Public markets continue to show how volatile they can be. A few news headlines and a handful of very large companies can swing returns in whole portfolios. The ability to add private markets to portfolios can lead to returns with greater diversification and lowered volatility. One reason: the opportunity set within private markets versus public is far greater, and it's growing as more companies are choosing to stay private for longer. The private markets also offer investors greater ability to invest directly in tangible real assets, which has a potential to provide inflation protection. We're excited about ELTIFs and what this regulation means for investors who want to build better portfolios in Europe.
Closed-end fund structures have historically made private markets investing accessible primarily to investors with deep pools of capital, a tolerance for illiquidity, and the resources to oversee the complex administration of private market funds. This has rendered the asset class largely off limits for private wealth investors. Evergreen funds are open-ended structures allowing investors to subscribe at a regular cadence with some degree of liquidity available on the way out. Committed capital is all called upfront, and investors come into a fully deployed, well-diversified portfolio from day one. ELTIF 2.0 has allowed funds to be offered to EU retail investors in an evergreen structure. Besides other positive developments, this is one of the key changes that makes ELTIF 2.0 more attractive than version 1. Since this could be EU retail investors' single allocation to private markets, there is merit in considering a multi-asset approach here. For instance, a combination of private equity and private infrastructure, accessed through direct and secondary opportunities. Not only would this offer the investors a more diversified exposure, but also allow the manager to adopt a more dynamic asset allocation, taking advantage of market-driven opportunities. It would also widen the investable universe of the fund, which is particularly attractive for an ELTIF framework given some of the regulatory concerns around the eligibility of assets. Finally, manager selection and finding the right partner could be challenging, given different managers may have expertise in different sectors, strategies, and geographies. Additionally, given ELTIF 2.0 is a relatively recent market development, not all managers would have an ELTIF structure available. A multi-manager ELTIF could solve this problem, where investors get access to quality assets alongside general partners in their areas of expertise, diversifying their exposure through yet another variable. Institutional investors have been using private markets to diversify their portfolios for decades. ELTIFs allow non-professional investors to gain access to those same advantages.
We've heard ELTIFs can break barriers to build better portfolios. But what factors should advisors and discretionary portfolio managers look at when building portfolios with ELTIFs? Importantly, how do ELTIFs fit your broader whole portfolios? Well, not all ELTIFs will be built the same way, so here are some key questions to think about. How much liquidity does the fund provide? When choosing an ELTIF that provides regular liquidity, there's an additional consideration to think about. The ELTIF regulation requires that funds with high liquidity hold more in liquid assets. As portfolio managers are well aware, a high amount of liquid assets can impact the total portfolio's return. That's why it's important to choose a fund with the right balance and risk management approach. What makes up the private markets portion of the ELTIF? ELTIF funds can be multi-asset and it can invest across primary funds, co-investments and secondaries. If the manager is also using secondaries within their ELTIF, it can help build private market exposures quicker and be able to give distributions earlier. It is also the only way to have vintage year diversification early on, as all ELTIF 2.0 funds will be brand new to the market. Single manager deals or multi-manager, not all best managers will come out with ELTIFs of their own, so it may be more efficient to use multi-manager ELTIFs to build a strong foundation in your whole portfolios. That means investors will get an extra level of diversification in a single ELTIF. Now let's zoom out to the whole portfolio level. Likely, the portfolios you build will have a home bias. So what makes ELTIF an attractive proposition for a European-based portfolio? Our research shows that the outperformance between European private equity versus European public equity is much higher than what you see in the US. European private equity compared to international markets also show lower dispersion in deal returns, lower deal level leverage, especially in mid-markets, and lower write-offs. Ultimately, it makes the case for a greater relative play in accessing your home market through privates whilst increasing risk-adjusted returns in whole portfolios. Let's assume the ELTIF you select is a multi-asset portfolio focused on capital appreciation. How will this look like in your balanced portfolio? Taking 60-40 portfolio as a proxy for a balanced portfolio, that's 60% in equities and 40% in fixed income. If risk reduction is the main focus, one option could be trimming down public equities to add 10 or 20% of this ELTIF. This shows much lower standard deviation in portfolio returns whilst elevating total returns slightly. But if increasing potential for higher returns is the focus, another option is to prorate down equally between public equities and fixed income to add either 10 or 20% of an ELTIF. This shows ability to add much higher excess return versus 60-40, while also maintaining or slightly reducing portfolio risk. We're excited to explore the role ELTIFs can play in your whole portfolios. Please reach out to a member of the Hamilton Lane Client Solutions team for further information.